Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about strategy in the current market and honestly give you a word of caution. Um, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. My cat is on the prowl, so maybe you'll hear some crashing. Maybe you'll hear him. I don't know what he's up to at the moment. He's currently in the window. I'm not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in pretty limited company, and sometimes I walk alone. So, where do we sit? Even more so than what I said last week, we have to exercise caution and extreme caution because that's the current market. But we have to exercise caution and look beyond that fear of missing out or the FOMO mentality. The fear and greed index is almost an extreme greed. I mean, I'll show that. And when you check my tabs, I really don't have much up today because we're not going to get into the normal stuff. But yeah, we're right on the cusp of extreme greed. So we're pretty much just at extreme greed anyway. So beyond the extreme greed, or maybe factored into that extreme greed, the FGI is a really good metric on newbie investors because you and me, you and I, we're trying to not get sucked in to where the herd is going. So that the FGI in general looks at newbie investors, and it's a metric of when to invest, but it's not the end all be all metric of when to invest. But when it pushes and when it pumps to extreme greed, it's when newbie investors are pumping money into the market and they're causing the cost of everything to go up. They're causing the value of everything to go up. Now, that's great when you own something. It's not great when you want to buy something, right? And when newbie investors get scared, that needle drops to the other side, and then you get into fear and extreme fear. And that's a great time to buy because they're selling everything and they're flooding the market with new shares, and now they're driving the cost down. So when the FGI is in extreme greed, it makes me considerably hesitate. And I said it last week. We were in greed and it's caution. And now we're in extreme greed and it makes me extremely hesitant. The the push from the market is buy so you don't miss out. Right? That's the current mentality. But if we look further, it's a very different picture than the current market. Both last week and as I read over this weekend, uh, Brett Owens, the only service I pay for, Brett Owens in the Contrarian Outlook released an article on Friday where there was a lot of good info inside it, and I'm not going to display the article. You hear my cat in the background knocking stuff off the counter. Um, he he had two important facts which caught my eye more than the rest. One, Congress Congress's current spending plans. They're spending 2 trillion more than what's currently budgeted. Now, that's a huge issue because every new law, every new 750-page bill, right, which is a completely different topic, but that's shitty legislation. But every package they put together has to be net zero in taxes. And the Congressional Budget Office, the CBO, their job is to look at all the bills and do all the money calculations because our congressionals suck at money in money management because it's our money and not theirs. So they just think it's theirs and they can do whatever the hell they want with it. But the CBO looks at how much money they're proposing to spend in relation to how much money there is. So we should always be neutral. We should always be break even. But the thing is, they're planning on spending 2 trillion more than what we have. That's concerning because it's gonna come from two places. Now they can hope that they're gonna if you run a deficit budget, you're gonna hope that you curtail your spending in some areas and then pick up and kind of like we saved 500 million here, so we're going to transpose or transfer that somewhere else and use 500 million there. But that's not Congress. Congress spends every damn penny and then more so. So we don't run a deficit budget. So where's the money going to come from? Well, it's either coming from you and me. You get higher taxes, which means for sure we're headed towards a recession, or it's going to come from the Fed's printer. Because when in doubt, why not just print it out? Now, if it's you and me and we're going to pay higher taxes, then yes, we're headed for a recession. That looming recession we all are anticipating isn't going to manifest the way they used to, which I'll get to. But it's going to depend on who wins the presidential election this year. If Harris wins, I don't think we have a recession. I think they recode it. I think we have a recession and a really bad recession. But I think the media and the dictionary changed the recession terminology again. Same thing they did about 3 years ago that says there's no way we're in a recession. I think they'll just change the terminology and sweep it under the rug. If Trump wins, I think they'll call it a recession and say it's horrible. But from my standpoint, I think Trump will make our economy better. The current labor statistics, the Fed's rate, the quiet QE they're already doing, all of those things point to us headed towards a recession. How bad it gets depends on who gets in office, and how bad it gets and how long it lasts depends on who gets in office. So back to why we're exercising caution. So the FGI is in extreme greed. Brett Owens' article with 2 trillion more in spending, which means either you and I are going to pay for that, or the Fed is going to print it, at which point you and I will still pay for that. But also in his article, also in Brett's article, he talks about the masses, Bloomberg, and a lot of other just newbie investors finally realizing they should invest in bonds. And we saw that at the end of the week. So when the Fed controls rates, which they have since the Titanic sank, when we move from higher rates to lower rates, that change causes uh, we'll say repetitive conditions inside the market, right? So take your existing stock market, take it at whatever level. If the Fed cuts rates, everything does better. People are like, you know, inflation isn't as significant. I have more money. That's a positive outlook. They spend more. They drop more into the market. Well, coming from higher rates to lower rates does cause the market to move higher, but it also brings out some level of recession, depending on who's in office and depending on how well they manage it and depending on how well it's covered. Because the media and dictionaries, et cetera, have been caught falsifying information regarding to recessions. They've changed the lingo, so the existing uh, presidential regime doesn't suffer the negative viewpoints. So or the negative I can't think. I'm still tired. Negative connotation for having caused a recession. So in the current market, things have gone up, right? So rates fall, stocks and bonds go up. In a recession, stocks fall, bonds continue to go up. So stocks right now, as tempting as they are still not tempting for us because we're looking in the existing market and looking forward And if we have a no landing recession, if we have a soft landing recession or a hard landing recession, meaning the Fed controls rates, labor data pulls back, GDP slows, economy slows, which we're seeing signs of that already. We've seen signs of that already. Then stocks would go down in value and bonds would go up in value. So buying stocks right now is not a great idea from our standpoint. Buying bonds right now is not a great idea because the overall cost of it is going up. So regardless of system, there's always a strategy at play. And you have to know your strategy. You also have to know the market. Now, we're not staring into crystal balls. We're not perfect by any means, but you're using the data you have. You're using historical data. You're using current data. You're factoring in all these other people and their advice, and you're not using all of those things to create your strategy. You're using all of those things as metrics to help steer your strategy, or maybe to best navigate with your strategy. So, given the current market situation and looking forward into the potential future of having some type of recession, whether it's said that, whether it's labeled that or not, stocks are not the place to be right now, but neither are bonds because everything's gone up. And this feeling across most investment platforms or most advisory services is go ahead and buy in now because the market's moving higher. You don't want to miss out. It's the fear of missing out. You're guilt tripped or shamed or sucked into that mentality. And the sheep are going through the same thing, right? The masses are going through the same thing. They're pumping more money into the market with the rate cut, and the market's going to take off. And then we hit the recession, and they don't want to lose money. So they're going to massive sell, they're going to dump their funds. It'll flood the market, and everybody's value will go down. Bonds will level and then go up. And if that happens, when that happens, that's the time to buy stocks. But for now, you can make whatever decision you need to do for your portfolio. You know your strategy much better than I know your strategy. And that being said, unless you're buying just an amazing discount, right? Or maybe it's a great dollar cost average move for you. Maybe you see a different move you can make now that'll help you 5 years from now. But my recommendation, my advice now is to not get sucked into the fear of missing out and to be extremely cautious. On our end of things, we are using the current market to help set us up for later. There are 3 funds that are earmarked in our portfolio, in our individual account, that we want to sell. And it's tempting to sell them day to day so that we can just be done with it, collect the funds, move them into our Roth account, end of story. But it's being patient and allowing that new money to flood the market, allowing time, right? Kind of like inflating a bicycle tire. 1 pump, you get more pressure. 2 pumps, you get more pressure. 3, 4, 5, 6, 7, 8, 9, 10. Eventually, you start to see the pressure returning to the tire. We're waiting for that moment where the price gets boosted enough to where we sell it, and then right? So you sell it, you collect the funds, you move the funds over, and even if they hang out as we wait for the next uh, pathway to become clear, because right now, so it's not bonds, right? Those are going higher. It's not stocks, right? Stocks are going higher, and in a recession, they'll drop. It's You've got real estate, collateralized loan obligations. There we go. corporate bonds, this bonds, that bonds, the other bonds. It's waiting until the water settles a little bit and it gets a little clearer to see until we note the next strategy for the next several years. Oil and energy is on the rise. Real estate is on the rise. Bonds on the rise. It really is a knowing the metrics and knowing your strategy and how that fits into the current market, and then looking ahead, right? Because there's no point buying something high to just have it fall out under your feet. Uh, you could argue buying bonds depending on what you're buying, depending on discount, which I'll get into why I haven't done the full system update yet. But you could buy bonds now, hoping they'll continue to go up in value, value, price, etc. But it's also that overall fear of missing out. The market right now has so much new money in it, and everything's going up right now. We're a month out from the presidential election, really just the entire election cycle for 2024. We're a month out. That's going to waver. But the market in general has so much new money in it right now. And if the Fed cuts rates again, it's just going to go up. Right. But I still think there's that very insidious economy sitting below the surface that is not as healthy as what the media is telling us. So why didn't I get the complete update done this weekend? Because I should have gotten it updated this weekend. And in my maybe my 3 years, 3.5 years of doing this, it's one of maybe a handful of weekends that I've not updated the complete system. Quite honestly, I'm exhausted. It's been a rough weekend. Uh, going into the weekend, my angle was caution, and that sentiment has only gone up since I started catching back up on articles on Saturday. But I'm exhausted. I didn't get to complete the closed-end fund review, and I'm not going to sit here and blow smoke up your butt and hoodwink you on conjectured numbers of what I think the market's doing in regards to I could present you last week's data on, whatever it is. It's the top 20 closed-end funds that are on discount and on our target list. I could present that and just cloak it for new data this week, but that's not me. So I need probably tomorrow, quite honestly, but I need time to go through and process the complete closed-end fund update, and it just didn't happen. Uh, I know we're not buying Monday morning. That might not be you, or maybe that is you, but we're not buying Monday morning. But quite honestly, unless you just get a fantastic deal, I would encourage you to play the current market, let it boost your existing portfolio, so then you can sell and prepare for the next wave. Because as we battle the waves, as we go from extreme greed to extreme fear, right, and then all the hiccups in between, and then extreme greed and extreme fear, you want to be prepped for extreme fear. And that doesn't mean you keep cash on hand, right? We've been teeter-tottering between fear and greed in various capacities the last several months, but we're finally into extreme greed. At some point, that pendulum is going to swing back and hit extreme fear, and we want to be ready for that. We want cash on hand and have a direction to go. And quite honestly, J.P. Morgan and Berkshire Hathaway are doing the same exact things. They're just doing it with a lot more money. So I personally, it irks me that I didn't get to do my update, but there's just only so much time in a weekend. But I'll get that done and I'll present the data next week. Uh, yeah, because me personally, I like checking things off a list. So when I don't get to check everything off a list. It just kind of like it creeps under my skin. Uh, but again, a mind only has so much bandwidth, and there is only so much time in a day. So on my end, I will update the system between today and the next video. And on your end, dig into your portfolio. And if you're managing it, kudos. And if you've got somebody else managing it, then you need to dig into it and see what you're invested into right now and see where your funds manager wants to go with it, but also see where you want to go with it. I encourage you to take a greater role in managing your money, because if you can learn to do this, you don't need to pay somebody to do this. The guy who still manages our uh, remaining portfolio, I guess you'd say, of just random inheritance money, we have very different investment styles. We have very different strategies when it comes to investing money. And my initial goal was to out earn him in dividends in the individual account. And then we blew past that. Uh, and then we started the Roth, and it's the same thing. Where I mean, between the individual and the Roth, we're blowing his numbers out of the water. But it's a very different type of investment structure, and long term, for closed-end funds and others, it's just not a great investment structure for us. So that's something we have to figure out. But know what you want to do, know where you want to go, and then, I mean, quite honestly, it's not going to happen unless you do something about it. If your person is not investing your money the way you want it invested, it's your money. And that person can feel all butthurt all they want. It's your money. So learn to manage it, learn to grow it, and then learn to do something with it. I mean, yes, you can let it sit and grow. Yes. But if that's all it ever does, then you're not actually doing anything with it. So it kind of depends on purpose. Like we could open a Roth for our kiddo, and it would sit there until at some point our kiddo needs it. But it for us of our strategy of having a Roth or an individual or anything, right? There's got to be a reason behind it. So know your strategy, know your reasons, uh, know your overall scheme, right? Know why you're doing stuff. And if you don't know anything about this, if this is all news to you, then you've got a lot of thinking to do. And if you want help in doing this, then come check out my Facebook page, because I get into all of this. I get into where you are, where you want to go, how your dreams fit in, how the strategy fits in, how to get out of having a full-time job. I talk about all that on Facebook. So uh, I'll leave it at that. It's otherwise I'll just keep rambling, to be honest, because I can talk finances, I can talk strategy. I love strategy. I can talk financial strategy and everything else in between, just kind of maybe not completely rounded about, but I can talk for a while. So uh, if you need help with strategy, come find me on Facebook at Navigate Your Finances. And if you want more information on closed-end funds, go back and look at my previous video or my previous videos where I talk about closed-end funds and why they're a great investment strategy. And next week, I will get back into a breakdown of the entire closed-end fund system and give you actual tickers, actual reasons with whatever we're doing, whether we're investing or not. So I wish you well. I hope you have a great week. And man, I really do. I need some sleep. So I will see y'all on another video. Bye-bye.